Okay, so we're just going to wait another minute while people come on to the seminar, and then we will start going through some of these hopefully fairly interesting slides. So give it one more minute, and then we can start. Hopefully as well, we won't have any issues because I was trying to run through some of this earlier on and my system kept crashing. So I'm hoping this one, we will now be able to get through it okay. All right, look, let's get started now anyway. Let me get my camera on for you guys so you can see me. Let's not do that. Okay, so we are ready. So look, first of all, thank you very much for everybody coming on. Appreciate Sunday. Often Sunday is a better day for people to have that time, and it's been very. We've got a lot of people on, so hopefully that's worked out for everyone. I know it's your Sunday morning, so we'll try and, or certainly it's your Sunday morning in the UK. We'll try and go through this in reasonable time. I'm hoping not to go over 45 minutes. I think after that, no matter how much you like a particular investment type or you have an interest in something, obviously that gets quite hard work after that amount of time. So we will be doing, this is the end of this February seminar. We're going to try and put together some, we've been asked to do some podcasts. So we're going to be doing some podcasts as well. So hopefully then we can sort of intersperse the podcasts so that you can get little bits of information from that. And then we'll go into a bit more depth on these live seminars. The other thing that you should look at as well, if you get the chances, is follow us on Twitter, Facebook, LinkedIn. We're trying to put out a bit more live information to people because I know, there's lots happened over the last, as this quote from Lenin says, there has been a lot happen, over the last year or so. It's been great for investors in property, certainly in UK property, but there's a lot to keep on top of. There's a lot to keep up with. So again, our Twitter, Facebook, LinkedIn, that sort of thing is really good resource for you. And we're going to start pushing some of the data pieces out there as well. So yeah, if you want to sign up to that, please do. I think they're all Baron Cabot. I think the Twitter's Baron Cabot Limited. And but yeah, if you need that, just drop us an email and we can send it over to you. Certainly I think it's a good resource. So today, look, we're gonna go through quite a few bits. A bit like last time, where we, if anyone who was on the seminar, I mean, we've got a lot of people from UK this time, where sometimes we'll have people from other places in the world. So from what I can see, we have Lagos on, we have Nairobi, and some Hong Kong individuals, and the remainder, I think, are UK. So we've got sort of a good morning, good afternoon, and a good evening. So. And some Middle East as well. Okay, so through the course of this seminar, let's briefly go over some of the news, what effect that news has on the market, what is that going to do, and then what I really want to do, and what I really like to do with sort of investors who aren't professional investors, is trying to show you how what factors go into property price growth. Now, this isn't a valuation course. It took me 5 years to really pass through all that sort of stuff. But what this is a whistle-stop tour. A lot of we have our own data analytics guys within the company, as most of you know. That's what we're what we're really known for. That's why these private wealth firms and IFAs and funds want to work with us all the time, and obviously individuals like yourselves. But also. A lot of the data analysis, and we've got a data analysis team, a lot of that stuff you can do yourself and get reasonable results from it. At least know the sorts of areas you want to look at. And then you can come back to us and ask us our beliefs as well. Some people just are, for whatever reason, nervous about speaking to us on a one-to-one to actually get that information direct. Maybe you think that we're going to try and just sell to you straight away, try and shoehorn a product onto you, which I think anyone that's worked with us knows is not the case. Our job is purely to, well, our job is initially really is to understand your needs and really fill in the gaps of your education, help you understand where you might be better placed with your investment, where you'll get a better return for every pound invested. But if you don't want to speak to us, at the very least, I can show you some routes with free resources online where you can start doing some of your own predictions and start to have your own understanding. When you see something in the news, you can research it, make sure it's correct. 9 times out of 10, they're a little bit correct and a lot incorrect in their assumptions. The press, they get a little bit of information and run with it. So we can show you how, you can understand whether, even if sentiment is down, should we still be investing? Even if everybody's saying, oh, market's terrible, should you be investing? And on the flip side, when everybody, like they are at the moment, saying it's amazing, should we also be investing? Sometimes it's the right time, sometimes it's not. Sometimes it's the right area, sometimes it's not. Generally, in any market, you'll find an area that we can make money out of. And so I'm going to try and show you that as briefly as possible, so you can go off and do that, and we can chat on one-to-ones this week, next week. I have actually put some time aside in my diary, and one of my colleagues as well, colleague Ben, has also put some time aside in his diary for. There's about 100 people on this seminar, and so obviously we don't have sort of 100 hours to give during the course of next week, but certainly, 5-10 people want to book some time in the diary with me. I'd be really pleased to go through any of this stuff in more detail, answer some other questions, or talk to you specifically about a type of property that might suit you. As you know, we have thousands, so more than happy to do that as well. So get those booked in as quick as you can. So, and then obviously we're going to go through what areas we're investing in, what affect all the stamp duty conversations that are going on in the market at the moment, in the press, what effect does that have on the property market, and what we're expecting from property prices growth this year, and then do a few Q&A right at the end. Obviously, we'll try and get as many questions in as we can, but just naturally, if everybody has a question, we're not going to get across it. A lot of the time in these ones, people are quite shy, so they don't come forward with any question. Please do. Please be sending as many questions as you can. It's interesting, keeps me on my toes. And also the other people in the group will probably also find that useful. So on top of that, obviously some of you have already emailed me questions, so that's great. I can go through those already, and thankfully I've had a little bit of time to, the one question was a bit tricky, so I'm glad I got that one not on the hop. So look, first and foremost, what's been going on in the news today? If we look at this middle article here, stamp duty extension, there's an expectation when the Chancellor does his budget on the 3rd of March. The Times newspaper were fairly bullish that we will have the stamp duty that was reduced to stimulate the housing market. That was due to end at the end of March. There's a fairly, I mean, it's pretty known now that's actually going to be now extended to the end of June, which is fantastic news for investors. That has stimulated the economy. There's no doubt about it. It's stimulated the property pricing as well, increase. And I'm going to talk to you a little bit about that as well, and actually the effect that, how to actually value property in and around that. And also the first time buyer piece, which I don't know if anybody saw, but that one was, I saw that one yesterday. I don't know if that was just when it come out, but this far right article where we're first time buyers in the UK are due to have guarantees. The government's going to guarantee the mortgage, and they only need to put down 5%, or I think that's the best they can do. But if they put down 5% for their property, and the remainder, the mortgage company can do with a guarantee from the government. I mean, you couldn't ask for anything more in terms of stimulating the property sector, certainly. So let's see how that goes. I'm fairly sure you're going to see a lot of spending, and we can go through that with our predictions later on. But naturally, you're going to see some serious purchasing from those first-time buyers, and also from investors, which is really superb. We're going to have to be looking at supply now, because I think there's going to be quite a shift in purchasing again. And the other point that I wanted to bring on here, which is just an article, we internally, there was some conversations about the effect of the stimulation of the stamp duty on the UK market, whether it was giving it was it a false bubble? Is there growth that we saw, this 6.5% growth last year, massive growth right at the end of this year, which we all saw. Would we then, is the growth because the market's strong and it's been given a little bit of stimulus, or what was it? Or was it just stimulus that's grown this? And I know we've got a question at the end, so I don't want to spoil it too much, but there was a question that came through from someone that was saying, to paraphrase, is the stamp duty discount, is that what's propping up the market? And then suddenly we're going to see this, for all the growth, we're going to see it drop out again. Well, the reason I've shown this German article is because other European countries have been doing the same. So it's not just because we've got that stimulus in place, it's not the only reason why the market's is so strong at the moment, because the structural integrity of the market is very, very good. So again, we'll go through that anyway, and ways whereby you can look at that yourself, and actually, because that's quite a that comment could be construed as me being pro property anyway. So I'm always going to look on the bright side of it. It's not true, but again, for those of you that don't know me, I'm going to show you how to look at this stuff yourself. So here's some information, and we're going to go through some of these again. I'm going to try and work through these quite quickly. I've got a recording of this. Please ask for a copy of it if you like, and we will use it for some people who are unable to make it. And also, please do just get on the phone to me or drop me an email. I particularly like it when people challenge some of the or question some of the numbers, some of the reasoning behind my work or the work of the data analysts, because the more we push and test the work we do, which is our job internally anyway, but obviously if there's more questions externally, it's great, because it just builds more strength into the work we do, improves our predictions day to day, year on year. As most of you know, we have these big servers, we have machine learning and artificial intelligence analysts within the company who predict property prices, right? So there's amazing amounts of data out there that we crunch, number crunch, and to predict only UK property at the moment, but we will be moving into other markets as well. And that data, we're hoping that you'll be able to access directly yourselves certainly in the next couple of months, where we're going to give you a website where you can actually just go and do this yourself. But for now, and the system will do it, but for now, it's great for you to understand some of the basics that go in behind property growth. So obviously the first that we really want to look at is supply and demand. It's exactly the same with, I think there's a calculator there. If there's not enough calculators in the world, and there's a higher demand than there is supply, there's a good chance that pricing will go up, as long as people need a calculator, I suppose. So again, if people need property, there's an undersupply. We should be able to, is one of the key sort of pillars of property growth, right? So again, it's hard to judge, because the problem that you get a lot of times is people will say, an example I get a lot is X city is oversupplied. So Manchester's one that sort of more recently people have been raising. Manchester's been doing amazing for people making huge amounts of money in Manchester. And a lot of investors start thinking, oh, wow, well, all the growth's already been done. And also look at all these, developments that are being built. Is there an oversupply? When my economics teacher, when we were obviously studying property in university, said if there was more than 8 cranes in a city, you were probably looking at an oversupply. I mean, that's completely changed now, just because of population density, in terms of the volumes of people moving to an area. So the first thing that you want to do is, rather than just saying X is oversupplied, let's find out if X is oversupplied. So how do we do that? How do we work out whether Manchester, as an example, is oversupplied? So let me just see if I can get onto another screen. Hopefully you'll be able to come with me on this other screen. We will share it. So bear with me. New share. Let me open this one up. So the first, I did make a folder for us for the purpose of this, and now obviously I can't find the folder. Oh, there we go. February seminar. Okay. So the first place we're going to go to understand supply and demand are 2 fairly useful spreadsheets, and you can get these online. So if you go to the government statistics, so these are called long-term vacancy rate. Okay, so this is what you want to be looking at. Oops, hide that. Sorry, let me just make sure I'm sharing the right screen. I don't want to be talking about one. Okay, so dwelling stock is the first thing. So what we can do is we've got 2. Let me see if we can do it this way. You can only see one of my screens at a time. Okay, we can only see one screen at a time. That's fine. So the first one is, if you pick out, we were talking about Manchester before, so let's pick out Manchester. So Greater Manchester, Central Manchester. Okay. So total number of properties in Central, 227,000 properties in total. And then we can go over here and we can look at this document, which is then vacant dwellings. So we want to look at long-term vacant dwellings in Manchester. And look, this is pretty interesting run here. So, sort of Central Manchester, you have been running from 2004, which is this far left number. Look how much fewer properties are actually left vacant. So there's 10 times vacant properties in Manchester than there was in 2004. And then you can, again, there's 227,000 dwellings in total. So you might want to do something like this, divided by your 227,000 properties. I'm crashing everything because I'm trying to go too quick while I'm on the phone. So look, you can see there that you've got, what is that, 0.5%? Where's my, here we go. It says 1, that's because it's rounding it up. Yeah, so 0.5%. So what I've just done there is looked at, we've looked at long-term vacant dwellings and then the actual number of properties in the city centre of Manchester, and there's not 0.5%. Then obviously your next thing that you could do is you could add in something along the lines of Manchester population. Let's just Google that quickly. Manchester population is city centre 553,000, 2.82 million in overall in Greater Manchester, but 553 in the city centre. So equals that divided by 553,000. Just, I mean, you'll probably be a little bit more, take a bit more time over these numbers, but it gives you, it's just to give you an idea. Again, then so you've got 0.5% actually available. That was up until 2019. So we're going to need to do a bit more digging and get new data, get more fresher data, which you can do once you start picking a city. 0.2% compared to the actual population of the city. So there's that assumes then that 99.8% of property is actually, or long-term vacant property is actually occupied, which is great. I mean, what more could you want than that? Now that's long-term occupancy, because we don't want to be looking at Airbnbs and things like that. We just want to look at like proper rental market, which we're going to be primarily targeting. Now that's all well and good, but we need a reference point. So what you can do, obviously what we do internally, but what you can do is you can start working through these. So you can start looking at cities, towns, maybe some that you like, maybe just looking at overalls, maybe looking at speaking to us or the towns and cities that I referenced at the end where we're investing. Go and do your own checks, go and have a look at how that would, or what your sort of vacancy rate is. Again, with that, you want to make sure that you're keeping an eye on population density, because the reality of it is you really want to be looking at areas where there's a lot of population density, so there's a lot of competition as well. But that's how we look at supply and demand primarily. Then you can go on land registry. So look at all the properties that have been registered. So go on land registry. I can show you it here. Let's just quickly show you it rather than trying to explain it. At least then you can do it yourself quite quickly. Where are we? Share screen. Here. Sold property prices UK, and go on the government one. Stay away from Rightmove and Net House Price. They just get the data from this source, so you may as well just go straight to the source. Again, so you can look at all properties between 2 dates in Manchester, for example, and then go on new build, right? You can then look at, well, how many new builds were delivered. Just run your searches off. So how many new builds were delivered over, the last 12 months or since that last report we looked at. Bear in mind, at the moment, land registry is quite slow because of the pandemic you might have heard about. So again, it's a little bit slow, the registry, so it's going to be a little bit behind. But again, you're going to have some really good information, right? You can get some very, very good information there. If you want to go deeper than that, you can start looking at, so where are we now? 1,219 new properties. So again, you can look at the number of new properties and then look at population growth. So how many people moved to Manchester in that same time period. What you tend to find with UK property is that there's a deficit. So almost always, as cities and as a country, we're almost always running behind. So the actual number of supply isn't keeping up to the demands in most of your major cities. And one city that actually is actually people are moving out, or there's predictions that it might be the first time it drops since 1988 is London. Although, it's a very, very resilient market. So I don't think it's going to have huge impacts, but just want to bear in mind that some cities do contract, but in the main, we're seeing them grow. So once we sort of nailed down supply and demand, I know we didn't nail it down there, but that's where you should be looking, and you can start working through those. The next thing we want to look at is affordability. The affordability, but then also the increase in affordability in certain areas, because you'll get some amazing information from this, in the sense that what we do often is we'll be looking at, the reason we look at gross disposable household income is because, or GDHI, is because what it does is it looks at where the person lives, it takes into account inflation, and it's not salary. So salary would be some areas of the UK predominantly have two. Each household predominantly has on average 2 employed people. But then there's certain areas of the UK where the property, the average is 1 or 1.5. So you're not, if you just based on average salaries, there's 2 problems. One is that you're not really getting the right predictions for property growth, because it could be 2 salaries in that household or 1 salary. And you'd be coming to some incorrect conclusions. The other one is often salary is based on where they work rather than where they live. GDHI is where they live. Now, the beauty of this is when you look at GDHI, what it does, skipping ahead there, what GDHI does is it allows you to understand not only do you get the information on, well, what is the affordability, and you can compare that to average property price in the area. But you will, if you're looking at it, and if you're coming to our seminars or hearing our one-to-ones that we do, also when we get new data sets out, sometimes certain areas their GDHI starts growing faster and faster each year. Now, that's one way you really want to look at it, because you start thinking, well, something's happening there, employment's happening there, or maybe a new train line's being built there, or tram station, something whereby it's drawing people in, and people are becoming either wealthier and wealthier in that spot, or wealthier and wealthier people are moving to that spot, or a bit of them both. So again, it's something that's really important to look at, because we've picked out some incredible areas where we've seen this growth happening, gone to look at it, and then seeing, well, actual fact, there's an undersupply there, and people are getting wealthier, and there's a logical reason for people getting wealthier. X, Y, or Z has happened, and therefore, yeah, let's look at that. Let's try and secure some property there. Let's get some developments. Let's start getting that out to our investors. So it's something you can look at as well. Again, this is why, regardless of how with us, there'll always be somebody that makes more money, because there'll always be somebody that already owned a property in these locations. What we're just looking for is these trends. So we're always just looking for the trend, and we want to just really catch the trend as early as we possibly can, but in the comfort that it's a real trend, that we're not we just see one thing happening for 1 year and then jump on it. What you want to see is some consistency in the trend, and then, a justified reason for the trend happening. And then from there, you're able to then buy in. And so what you'll get by using these sorts of ways of property forecasting and investing is, you'll be much more consistent. You'll almost always be in and around the property growth, right? You're always going to be in and around sort of rental growth and good rental returns, high occupancy rates by doing this piece of work or doing it with us. Because ultimately, part of the problem that we get is that somebody will say, oh, my friend made loads of money in X location. Now, the thing is, it might be was that luck or strategy? Sometimes you can get the right result, but your decision was incorrect. What you want to be doing is strategizing why certain places will be. It might mean that actually the place where your friend invested is still a great place to invest. But what a lot of people do is they see their friend being very successful in property. They don't know if their friend was actually any good strategy, or just happened to buy in an area that did particularly well. And then they follow them because they say, well, this guy's made millions. All right, fine. But most people that have invested wisely. We need to make sure that their strategy is correct. If their strategy is in line with what we're suggesting, then yeah, go ahead and listen to what they say. Otherwise, be incredibly careful. Just because one person's made a decent amount of money from it, it doesn't mean that that's going to continue working. So you've got to be sensible. Other people, it's just the fact that, look, if you invested anywhere in England 10 years ago, you would have made significant amounts of money by now. So the job's also to try and improve on that. Just by, you could throw a dart at the UK 10 years ago, bought the property that it landed on, you'd have more, on average, it would have grown 3% per annum anyway. So what we want to do is significantly better than that. So how do we improve on that? By using these sorts of strategies. So that's GDHI. Sorry, let me briefly show you a GDHI document. I'll show you just very briefly. I was going to take you on the website and what have you, but I don't think I think we're better just pulling up a report. It's one that I did actually with a really nice client of mine. So let me share, new share. So let me share this document with you. So again, what we're looking at here is gross GDHI basically by per year. And then what these numbers are, what we were looking at was, okay, well, what does that, how's that growth look like? Is that increasing? You know, what was the average growth? What's our expected growth? So you can start to look at areas. So again, we were looking at Manchester before, so let's keep on with that one. Let's look at the color scales. So it's fairly consistent growth. I mean, look at this. There was a little drop here in 2016. So worthwhile understanding why that was. But then, yeah, we've seen sort of last couple of years, it started to really ramp up in terms of affordability. So what you tend to expect is that property can afford to grow by at least 6%, right? Because the earnings have. And this is exactly when you look at markets like London. Well, why did London stop? Because it had everything that it needed. It had, supply and demand. Everybody wants to buy there. Obviously mortgages freely available and cheap, or as many, probably more mortgages available for London than anywhere else in the country, because lenders love London. But what is it that stopped the growth is that actually, and you can see it here actually. So, look, the average property price is 16.5 times the average salary. So you're starting really, once you get over 14, 15, you see like Harrow here, you're going to be expecting that to really slow down in terms of price growth. Look, the Birmingham here is still on 11, so it's still got a bit of time to go until it's maximized. So what happens is property growth happens like this, and then it starts to plateau. And it will only then really grow once it's maximized, and there's no real more money or there's no more price increases that can go because people can't afford to pay the deposits or the mortgages. What happens then is it starts to plateau, and it'll only really grow at the level of average earnings. Now, there's caveats to that, because that'd be a city overall and commuting and what have you. There's still going to be bits, sort of areas of cities where there's a certain amount of regeneration. Maybe they were priced a bit cheaper because there was no transport links, and a new transport link comes, so we can get growth that way. But we're talking about on average, these are sort of where you sit. So again, we're looking at, and also property price growth. You can see growth here. I mean, you've got to be careful by looking too much at growth in 2020, because a lot of the stuff's not been delivered yet. So a lot of the completed properties haven't been added to the land registry. So again, when there's not enough data to look at, sometimes it can give you problematic figures. So be careful with that. But overall, UK is performing well. And by looking at GDHI and GDHI growth for certain cities, that you've already looked at supply and demand. So, there's a need for property, and then can the property prices, can they afford to go higher? Because again, the other one is that you always get is these property prices are ridiculous. They're so expensive. We do it all the time. We look at something and your gut reaction is it's getting expensive, Birmingham or Manchester or wherever. And then the next year you look back at that property and it looks cheap, because the property prices are going up so quick. So again, you've got to go back to the data really with it, especially when it's a town or city close to you that well, that, people say, oh, remember when, the property prices here were only 120,000, now they're 250,000 5 years later. Well, that's great, because you're on a trend. So buy there unless affordability can't get it. Stop looking at areas that aren't growing, where the property price is still the same price as it was 10 years ago, because it means nobody's buying it. The market's telling you what to do. The trend is your friend, as they say. So, because you get it a lot, these obscure areas of the UK where property is very cheap, rental yields high, but there's never been any growth. And people think, well, this is a market that we're predicting, as it were, but there's nothing to back it up. There's no data showing that in actual fact there's more people moving there, that people are becoming wealthier. So there's no real reason why that property price will grow. So there's various areas of the UK where that happens. So again, bear that in mind. Just be sensible. Use trends, use your analytics, use all this logic, to make your decisions, and then you'll make money. You know, if you're just trying to use emotion or what your friend down, you know, said to you last week, you're not really going to get anywhere. And also, you don't understand why you're investing in something, which is pretty dangerous thing to do. You know, UK property is incredibly safe, but just you know, especially compared to other financial pieces, you know, we know that you can't keep it in your bank because it's pointless. You're just losing money against inflation. So we've got to look at bonds or, you know, shares or Bitcoin if you really know that. But look, I mean, property is always the favorite. So again, and we can talk about why the market's growing and why people still love it internationally, why people still absolutely adore the market. But let's just look at these last couple of bits on how to predict property prices and how to predict where you should be investing. So then the next one is property prices will only increase if we've got access to lending. So we need, you know, part of actually the growth of UK property was, you know, we've got a private commercial mortgage industry, right? So these people are competing to lend at better rates to be able to give you more. And lending is so cheap at the moment. It's something you really want to be looking at. I mean, you can borrow for next to nothing, especially if you're a UK citizen. It's incredible the mortgage rates you can get at the moment. So anyway, so look, one of the major things is lending levels. So you can keep an eye on lending levels. Go to the Bank of England website here. I've got it on this slide here. Anybody that wants a copy of these slides, please let me know. I will send you a copy. But ultimately, lending rate will interbank exchange rate, obviously, because that leads into what the banks can lend you. So the cheaper they're borrowing out, the more money they can put out to you. All right. So again, that's probably a little bit much to go through. Start looking at interbank exchange rate at the moment. It's something that we look at as a company. But for you, what I'd be looking at is lending levels. Just look at the Bank of England. Look at how much money was lent over the last month, over the last quarter. Is that pretty consistent? If there's big drops in the amount being lent, it's something you should look at the market overall. You know, is there an issue with the market overall? Are lenders pulling out? If lenders are pulling out, is it just for a small period of time because they need to have a look at things? So March, obviously, when the pandemic really hit UK and there was lockdowns, you know, a lot of lenders pulled out the market. They just wanted to catch their breath. Same with a lot of investors pulled out the market. Everyone sort of went, right, you know, what's going on here? Let's have a look at this. The lenders were no different. But ultimately, lenders have to lend. That's how they get paid. So they want to be able to give you money. But again, yeah, looking at that, how many loans, how many mortgages are being given out? What are the mortgages for? Are they buy-to-let mortgages? Are they, you know, are they mortgages for owner-occupiers? Are they remortgages? All this information will give you additional knowledge onto the market and also something what to expect in the future. Don't wait for somebody to say, or the newspaper to come out with, you know, something saying banks have pulled back or property prices are affected by banks in a positive or a negative. You know, go and look at it. You know, you can go and find that information before the press. You can go and find that information before we send it to the press. You know, it's just go and look at that. I think that's a really interesting one. It's not, I mean, look, access to UK is pretty good with mortgage lending anyway, so it doesn't make a massive, you know, it does make a difference clearly, but you know, GDHI and supply and demand is probably ones where you really want to focus, and then just make sure that actually lending is still being quite fair. Again, please bear in mind that it's with property, it's time in the market, not timing the market. Ultimately, if you believe that all of these things are correct and everything, you know, the way the structure of the market is correct, I mean, you know that your property is going to be worth more in 5 years' time. Don't try and predict a drop for 2 months, you know, because generally what the people that do that are trying to look at, well, it might drop a little bit in 6 months' time. Generally, these people actually don't buy. They're kidding themselves into thinking that they're an investor, and actually they just are uncomfortable, scared to invest in the market. That's normally what you find with these people that say, well, I think there's going to be a little drop in June. Well, ultimately, if the property price market's going to be higher at the end of the year, buy now. If you really want to, then learn using this information where you think that's going to be. You know, unemployment's going to increase. So property prices are going to reduce, is some people's argument. Okay. So what's unemployment going to grow to or go to? 2016 level, 2014 level, 2012 level is the catastrophic. That's one of the worst that I've seen in terms of predictions wise. That's amazing. You still understandable. It's not amazing for the people who lose their jobs, but ultimately, if we're not talking like huge layoffs, you're talking about going back to 2014 levels of unemployment. We had record employment in the UK. So if it does go back to that, well, what happens to the property market? Well, historically, when there was job losses, we didn't actually see a drop in the property market, which is interesting. But if you are expecting that, or affordability you're expecting to drop 1%, what are you saying? Property market will drop 1%. Therefore, rather than waiting till summer, offer on a property at that reduced amount. Understand what you need to buy for. And again, this sort of stuff will show you that. Stop saying I'm waiting for it to drop. Say, well, what will it drop to? Or what margins do I expect it to go to, property prices? And then that's where I'm going to buy at. Conversely, the market, most people are suggesting the market will grow this year. So even some of the most pessimistic predictions are now growth. So unless you categorically disagree with that, you should be buying property, or unless obviously you know better investments, if you're a great equities trader, stick with that. Then the last thing really, which does have an effect because it has an effect on you and me and everybody else, is sentiment. So ultimately, if there's a bad feeling about the market, it will perform worse, right? Now, sentiment, I almost had sentiment gray at the bottom of these slides because I didn't want sentiment to be, we didn't want to focus overly on sentiment. The reason being is ultimately you should be buying. If sentiment's low, but everything else in the market is correct for you, it's often the best time for you to buy. If you know the market is actually strong, but there's just some insecurity in the market, for instance, certain political changes, when there's the next, when there's a new vote for, whether, Labour, Conservative, whatever, everyone goes to the polling stations. Sometimes it can be insecurity there. Now, sentiment might be low then. That can be the best time to buy. Equally, when sentiment's really high, like it has been recently, well, don't make sure you're not overpaying for property, right? So you need to know when sentiment's high or low. And ultimately, you need to be working with your own data and not just because press say it's amazing, the market's at an all-time high, we've seen the highest number of transactions in 10 years, we've seen yada, yada, yada. Well, just still be paying the right amount for a property. And equally, when this stamp duty finishes, there's going to be a slowdown in the market because people will try and buy their property before June, and then means that July, there won't be very many transactions, right? Even though everybody knows it's coming, it always happens when there's a tax change. So there won't be many transactions. And the transactions that do happen, what will happen is the seller will split the difference on the stamp duty, right? So if, say the stamp duty was £10,000, the seller might reduce their property price by 5,000, say to the buyer, well, look, I know you missed out on stamp duty, but let's split the difference sort of thing to get this sale over the line. Now, what that'll show on the sold prices is it'll show it as a drop. In actual fact, it's not a real drop. It's just that because of a change in tax, the people have negotiated a slightly different amount. It doesn't mean the value of that property is different, right? And this is the important piece. Equally, the massive growth that we saw in property prices, well, that's people paying a little bit over because they don't have stamp duty to pay for. So they don't mind paying a little bit more than they normally would for their property, right? Now, what you want to forget about is this sentiment. You want to look at true value of property by looking at these other aspects. But to understand sentiment, and sometimes it's in your favor, is things like Google Trends. So go on Google Trends. You can then type in buy-to-let property in Birmingham, buy-to-let property in Manchester. You can look at just UK searches or worldwide searches. And then you can look at the trends. Are more people searching for this stuff or are less people searching for this stuff? Also, is it a positive or a negative? For instance, will I lose money on property in 2020, whatever, will there be a drop in the market? So these negative keywords as well you should also search for. So again, it's a bit much really for you to do yourself, but it's just, I wanted to give you an example of how you can look at sentiment other than just reading the paper. You can actually look at what people are doing there. Okay, so that is a very, very quick tour. Oops. Very quick tour of pricing because we are running behind really. So I need to sort of start wrapping this up for you a little bit. I was going to work through all the areas in terms of on the maps where to focus on within specific cities, but I think you're going to have to do that on a one-to-one with me, or maybe on another seminar, because I don't want to keep you guys for a long time. But ultimately, where we're investing at the moment, Central London is back, very much so. I mean, we're buying a lot of central sort of multi-million pound apartments in London. Sort of our high, we're doing a 35 million pound apartment, we're doing a 40 million pound house, and then sort of everything in between. So there's a lot going on in London at the moment, and with serious investors that know the market very, very well. So while it's not as exciting as it was previously, and it's probably not as exciting for most people as Birmingham or Manchester, it's definitely one that you should look at. If you've got the cash, if you're sort of looking at £1 million plus, and you want something that's pretty secure, Central London can be great. You know, so we've got quite a lot there. We're actually taking on more developments in London for the course of this year. So again, look at that. We can talk you through those if you want to look at the London market. Then obviously Manchester. I mean, Manchester's been phenomenal for most people. There was a little oversupply. I know I was saying the supply and demand on Manchester. There was an oversupply in the sense that a lot of developments delivered at the same time, but ultimately they are needed. It just meant that rents were affected. So they'll even out over the course of this year. There's another few, I mean, there's some luxury stuff completing, I think, this year. You've got Deansgate Square completing this year, which is the Renica project, which is really sort of pricey stuff. I mean, beautiful product. But top end of the market, their stuff's finishing. So there's other stuff around that price point sort of finishing soon. So your luxury rental stuff in Manchester might be, you might see a little bit of the yields might not be quite strong in 21, but then again, like, you know, looking at 5 years, they're going to do great. But you know, there's some stuff that mid-market is really quite interesting to us at the moment. So maybe not quite bang central, maybe just outside, looking for stuff on a waterfront, stuff whereby people can have outdoor space because people will still have the lockdown in their heads, you know, maybe a roof terrace, that sort of stuff. So, and again, rather than paying sort of 400, 500,000 two beds, if we can be buying in at sub 300,000, I think we've still got, you know, really, really good stuff to go at in Manchester. And obviously anything cheaper than that, you know, you sort of lower end stuff a little bit further out. I know some of the guys, I think Sir are doing quite a lot of work out in sort of Stratford area. I know there's in the north of the city towards the sort of Manchester City Stadium, Etihad Stadium. There's a lot going on around there. So some really, really interesting stuff coming up around Manchester that, you know, has a real logical case behind it and can be backed up. Again, affordability, supply and demand can back it up. Other ones, Birmingham, you know, you can't, I mean, at the moment, Birmingham has to be the sort of number one choice for most people. If you can afford it, you should be buying there, really. And obviously, you should only be buying it if you can get it at the right price. You know, again, going back, look at the data with us, make sure that the price per square foot and the price of the product is correct. But not only the HS2 coming to Birmingham, which, you know, you can't call it a no-brainer, but you have to be looking at it saying, wow, like we're never going to get this opportunity in our life ever again. You know, so if you can, buy next to these HS2, but also it's the tram stops, you know, all the infrastructure that has to be built to sustain this huge, the biggest spend that the government's ever made on a transport link, you know. Well, as soon as that comes from London to Birmingham, well, all these people need to move around, you know, they need to get on a tram or a bus or whatever it is. So and Birmingham's historically got horrific transport infrastructure. So again, Birmingham's superb, you know, have a look at that. The smart money is obviously next to the HS2 stops if you can afford it, you know, great. But But there's a lot of smart money in and around like little places where there's new tram links. You know, a new tram stop will add 15% potentially in a year to your property value, right? We've seen this. There's loads of reports on it. You know, that is then absolutely, if you can buy anything next to a new transport link or where one's about to be built, which you can get, you can understand that. Again, go on planning applications, go and speak to us. Where are all the new tram stops going to be in the UK? These are absolutely amazing places to buy, right? Make someone's life easier to get to work. They'll pay more for their rent, property prices will increase, etc. So again, keep an eye on Buckinghamshire as well. It's cheap. And I don't mean it's cheap in terms of the property prices are cheap. I mean, it's cheap in terms of affordability. People's salaries are strong compared to the average property price. Again, there's the only sort of consideration there is not a lot of, it's not dense. There's not a lot of population density. So it's a bit harder to buy. I'd just be keeping an eye on it at the moment. You know, it's something we're looking at, you know, we'll maybe sort of pick it up in, you know, 6 months time or what have you, it's just there or thereabouts. But if you see something that you think is fantastic there, look at it. The other one's Kent. We certain parts of Kent now, you know, cheaper. They've got the new film studios going there. It's green. It's you can commute to London very, very easily. So I think a lot of people now, or what we're seeing, you know, it's not I think, it's that, you know, the reports are showing that, you know, there's something like 400,000 people that live in central London who have said that they were going to move outside of the centre and look for more space. So I still think there's still definitely a demand for, you know, 1 beds, 2 beds in the city centres. I just think that maybe you need that outdoor space for people. I think the people who've been locked in a 400 square foot 1 bed with no outdoor space found it really tough during the lockdowns. So look for roof gardens, look for outdoor, you know, it's on a canal, it's green, what have you. Well, Kent has loads of that. So, you know, again, your people are able to buy next to, you know, next to some of these really nice sort of green areas of the UK. So keep an eye on that. 2021, I'm going to fly through this. Again, I've spent, like normal, I've spent too much time going over each slide. We were expecting a mid-year dip, obviously after the stamp. So once the stamp duty goes back up, market will slow, newspaper gets hold of it. Newspaper says the bubble's finally burst or whatever they say in property, and they do it, you know, once a year or once every 2 years. You experience people disregard that these days, but, you know, for some of you guys that haven't invested before, this is what happens. They then panic the novice investor doesn't buy or puts it off for 6 months. Market slows a little bit. Experienced investors get amazing deals, right? So we were expecting that just for a blip during the summer and then it to jump back up by the end of the year. Once people actually look and go, you know, the market's great. But ultimately, that might stop now. So Bank of England have said that's not going to happen. You know, there's various resources where they're saying we're not expecting a dip. That initially we thought it might not happen because the vaccine rollout is expected to be pretty much, you know, most of the high risk people will be vaccinated by summer. People will be allowed back out. People will have saved up huge amounts of money. There's going to be this surge of sentiment, you know, people on holidays, spending money, etc., investing in their future. You know, there's all this sort of thing. So we're expecting that to negate a lot of the issues of stamp duty piece. Now, if stamp duty is being pushed back to after June, you know, we can't, by which point all the, you know, the vaccines are run out. It may well just be that we don't see that dip at all. If we do, it's literally, it's not a true value dip, it's a sentiment dip. So you should be investing now anyway. You shouldn't be thinking, I'm going to get a bargain then. You won't, probably. Most people will just hold. So don't expect it to be some sort of, you know, major market discounts. There will not be. Developers will hold their stock, just sell it a month later. And no investor is going to sell something off a few percent cheaper just because of the certain month. So again, don't expect that. Significant international investment is, we're going to see huge amounts over this year. We've seen massive amounts already. Countries with high inflation at the moment, countries whereby their own countries are unable to stimulate the economy, are seeing inflation growth, and all of these people are trying to get their money out. So West Africa, East Africa, South Africa, various parts of Asia, the Middle East, all of these people are getting their money into the UK as quickly as possible. So Again, even when sentiment was low, a little bit low in the UK, because people were fed up being stuck inside, what a lot of UK investors missed out on was the surge of all the international investors. They took massive advantage of that. Now UK investors are heavily back in. Now they can see that the end is near, as it were. Sounded a bit, but you know what I mean. Like the end of the sort of the lockdowns are coming. People, UK investors are heavy back in. So we've got a lot of people investing, probably looking at around on average 4% growth. But we can definitely be investing in, and we should be getting higher than that with some, you know, smart investments into various parts of the UK, which you guys should speak to me about. So look, guys, I'm really sorry. We're going to have to stop there. We've got some Q&As. I'm going to just respond to these guys in one-to-ones. If you guys have want the same answer to these questions, I think I've pretty much gone through them, to be perfectly honest with you. So, so look, let's drop it there. Thank you so much for coming on. I appreciate you taking out your Sunday. I'm hoping that I've given you some real helpful advice rather than just trying to sell stock, which I don't understand why people do. Once you understand all of this stuff, you'll know why we pick our investments. We are completely independent. We work the whole of the market. If there's one property somewhere that you want, we can get it for you. There's often logic why we don't like it, why we're not pushing on it, why we're not offering that to our IFAs or private wealth firms or to you. But please ask me. As I say, we have some space in our diaries for one-to-ones. Please, please, please get yourself booked in as soon as possible. Otherwise, you'll miss it. But I'd be really keen to speak to some of you guys on one-to-ones. We'll do a background sort of information on yourself, what it is. You need short-term returns, you need longer-term returns, what budget you're working to. Here's the type of areas of the UK you should be focusing on. And if we have a product there, then great. You know, we'll show you that product. We'll show you why we picked certain products. If we don't, we don't. You know, we just send you on your way to go and look for them. Normally we will do that. We can help. So yeah, get in contact with us. Let's get you booked in. Email me or Rachel, who set up a lot of these seminars, and we can sort of have one-to-ones with myself or one of our directors. All right. All the best. Enjoy the rest of your Sundays, and look forward to speaking to you soon. Thank you.